Hello and welcome to our in-depth analysis of the silver market. Over the past year, silver has captivated investors and analysts alike, surging from $22 to as high as $35 per ounce. But what does this price movement mean for the future of silver? Is $40, $50, or even $60 a realistic target in the near term? And most importantly, what factors are driving this unprecedented demand for silver, and how are the markets likely to respond? In this comprehensive breakdown, we'll explore supply constraints, industrial and investment demand, and the potential for another silver squeeze. Make sure to subscribe to our channel and hit the bell icon so you never miss critical updates on silver, gold, and other precious metals. Let's dive in. Silver prices have made remarkable strides over the past year, climbing from $22 to $35 per ounce. This upward momentum has sparked debates among experts regarding the sustainability of these price levels and the potential for further gain. According to Peter Krauth, a renowned precious metals expert, the recent surge is only the beginning. Krauth points out that the price levels of $40, $50, or even higher may not be sufficient to balance the current supply-demand equation. Industrial applications for silver are at an all-time high, driven by growth in sectors like solar energy, electronics, and electric vehicles, with silver being a critical component in photovoltaic cells and high-tech electronics. Demand has been going through the roof. Solar energy installations are expected to grow exponentially in the next decade, creating a sustained demand for silver. The electronics industry, including 5G technologies and consumer devices, continues to expand its reliance on silver. Silver has long been considered a safe haven asset during periods of economic uncertainty. Recent market volatility and rising inflation have only reinforced silver's appeal, with investment demand through exchange-traded funds, ETFs, and bullion purchases seeing a notable uptick. The silver market has been grappling with a consistent supply shortfall for the past 4 years. According to recent projections, 2024 is expected to see a 20% supply deficit, adding up to a cumulative shortage of 740 million ounces over the past 4 years. About 75% of mined silver comes as a byproduct of mining other metals like copper, gold, lead, and zinc. Only 25% of silver is produced by primary silver mines, making the market highly dependent on secondary mining operations. S&P Global Intelligence projects that silver production from primary mines will peak in 2026 and then begin to decline. Recycling accounts for just 15% of total silver supply, and experts agree that it is unlikely to increase significantly in response to higher demand. With mining output stagnating and recycling limited, the market's ability to meet rising demand is constrained. Many market observers have suggested that higher prices might incentivize private silver holders to release their stocks into the market. But Krauth challenges this notion, emphasizing the uncertainty surrounding the price at which private holders might sell. In an inflationary environment, silver holders may be reluctant to sell, viewing the metal as a hedge against economic instability. Even at $50 or higher, there's no guarantee that private stockpiles will enter the market in sufficient quantities to meet demand. The silver market has experienced similar dynamics in the past. In 2016, silver prices surged by 40% within 6 months, driven by a combination of investment demand and supply constraint. According to Thomson Reuters, GFMS global silver demand hit an all-time high in 2016, with ETFs and stockpiling playing a significant role. Mine supply dropped by 0.7%, creating a significant supply gap of over 9,500 tons. During this period, junior mining stocks, often more sensitive to price changes, saw explosive growth. The SJ Junior ETF, for instance, gained 8 times more than the price of silver itself, highlighting the potential for outsized gains in this sector. Junior mining stocks have historically outperformed during silver rallies. As silver prices rise, these smaller companies often see disproportionate gains due to their leverage to the underlying metal. Market caps: many junior miners have smaller market capitalizations, making them more responsive to price increases. 2023-2024 outlook. With silver prices already showing strong momentum, junior miners are well positioned to deliver significant returns for investors. Silver squeezes occur when demand outpaces supply to such an extent that prices are driven higher in a short period. The conditions for another squeeze appear to be brewing. With a 20% annual supply shortfall and cumulative deficits nearing 1 year's total supply, the market is under immense pressure. The rapid adoption of green technologies ensures that industrial demand will remain elevated for years to come. Retail investors and institutional players are increasingly turning to silver as a hedge against inflation and geopolitical risks. Looking ahead, analysts are forecasting continued strength in the silver market, with 2025 projected as a pivotal year. Key price targets include $50 per ounce, a psychological milestone and a potential test of silver's all-time high. $60, $70 per ounce, bullish scenarios driven by persistent deficits and rising industrial demand. The silver market is at a critical juncture. With prices already surging and demand far outstripping supply, the potential for further gains is significant. Whether through rising industrial use, increased investment demand, or the possibility of another silver squeeze, silver appears poised to shine even brighter in the years ahead. Let us know in the comments, where do you think silver prices are headed next? Will junior miners outperform again? If you found this video helpful, please like, share, and subscribe to our channel. Don't forget to hit the bell icon to stay updated on the latest insights into the silver and gold markets. Thanks for watching, and we'll see you in the next video.